All right. Here we go. Well, hey everyone. We're going to dive right in right away, but just want to say very excited to kick this webinar off and let our audience here and anybody who's listening to the recording in on some of the insights that we're going to talk about today, really beyond the pitch deck. And some of the stuff we're going to be talking about is why investors care more about your financial systems than you might be thinking. I've got two special guests with me today. We have Alan Langelli from Aprio. He is an audit partner there, the technology lead in the Mid-Atlantic. And then we have Alex Diaz-Asper, who's the managing partner and founder of Tarsus. I'll pass the mic to them just here shortly to introduce themselves. I'm John Cochrane. I am our general manager of payments and partnerships here at Maxio. Maxio basically is a tool that helps you with billing, subscription billing, revenue recognition, and then insights on your top line metrics of the business. So we've been around for almost 20 years now. And those are the things that we do well. So Alan, I'll pass it to you. And then Alex, you round us out, and then we're going to dive right in.
Thanks, John. Great to be here. Looking forward to this conversation. Very excited about what we'll cover today. Alan Langelli, partner at Aprio, which is a nationally recognized accounting and advisory firm. We serve a wide range of industries, but our largest is within the tech segment, and I sit on our national leadership team supporting our over 2,000 tech clients.
Fantastic, John. Great to be here. Thank you for having us. Alex Diaz-Asper, I'm the managing partner of Tarsus. We are an outsourced office of the CFO, meaning we do all the core accounting, financial modeling, planning, KPI tracking, CFO work for our clients. We work with a lot of different types of business, but our biggest practice area, just like Aprio, is in the tech space. Pretty much pre-seed to Series C is kind of clients we're helping with.
Awesome. Thank you both. Now, one of the things I'm really excited to talk about today is, we've kind of got two people on sometimes opposing ends of the aisle. You have Alex, who's coming in and helping, the customers get their books right and can actually do some of the work. And then you have Alan and his team who are coming in and they're double checking all of Alex's work. And so it's sometimes rare to get both people in the same room because there's like a little bit of like a friends, but adversaries, but we all both are working toward the same goal. So hopefully that'll be interesting for the audience here. And the good thing for this audience is, from what the rumors tell me, they'll neither confirm or deny it because they have to maintain independence, is that, Alex is one of Alan's favorite CFOs.
I'm willing to go on the record to say that. Yeah.
Fantastic.
No, it is helpful. And I think that's one of the things that we want to be able to share with this audience is they do bring, unique perspectives and some real tangible stories that we'll be able to dive into today. So one of the things that, I think is always interesting is, we're thinking about, and I'll go ahead and drop the slides. We won't need that for the rest of the time here. One of the things that I think is really interesting is, you've got these first-time founders who have this great new innovative product. They're bringing it to market and, they're going fast. We're going to the moon, basically. And then you have second-time founders. They've been there. They've done that. And there's, doing something for the second time. There are always lessons learned and experience that you bring into that next startup business or that next venture that you're going into. Where I wanted to start the conversation for today is, and Alex, we'll start with you because many times you're rolling your sleeves up with many of these founders who are starting the businesses, but there are lessons that they've learned from being around the first, doing that venture, doing the startup business the first time. And so the question for you, Alex, is as we dive into this, what are some of those things that a second-time founder will never do it again, or they're going to make sure that they get right from the very beginning, given their experience?
Yeah, that's a great question. I mean, luckily, since we've been around for 16 years, we haven't had the opportunity to work with certain clients on a repeat basis. We've seen this play out with the same entrepreneurs in certain circumstances. But essentially, you want to do it right from the start. There's no reason to postpone just basic blocking and tackling as far as, the key parts of your business. When I say that from an investor standpoint, especially in early stage tech, it has a lot to do with tracking revenue growth, the KPIs around revenue, like churn, all those kinds of good things. So just getting all that sort of set up, your policies, how you're going to handle contracts, your documentation, getting all that set up from day one, and then it's easy to scale. You're not dealing with it when you're trying to do a Series A or a Series B or post Series B, and then there's a lot of painful rework at that stage. So doing it from the start is usually the easiest long-term solution.
That's now, and one quick housekeeping item I forgot to mention. As we're having the conversation here between myself, Alex, and Alan, if you have questions for myself or either of them, please post it in the chat. We will deal with that as we go, and we love your questions and feedback. Alex, when you mentioned kind of some of those basics, revenue recognition, contract management, to myself, call it still an active but recovering CPA who was always fighting for relevance on accounting teams within a business. I'm like, yes, that is exactly what people should be caring about. But many times these founders, it's like that. Well, that's not tied to sales. That's not tied to product.
Right.
That's not tied to something that's going to help me grow the top line of my business. That's like back end bookkeeping. And, that's why you're here, Alex. I'm curious, Alan, flipping it to you, like why is it contracts and like getting those structured correctly? Like, what is it about that's so relevant to second time founders?
Yeah, there's two reasons that come to mind. The first one is on the diligence side. They realize how much effort goes into diligence, whether it's raising your Series B or maybe doing buy side or sell side, and how important it is to have a lot of your contracts and a lot of the back office buttoned up, because it just allows for a much smoother process on the diligence side. And if it's not buttoned up, it distracts then when you're going through diligence to be able to focus on product, to be able to focus on sales, to be able to focus on marketing, to really drive growth for the business. And then the second piece is it can very, very much meaningfully impact valuation. If you're being measured, whether it's a revenue multiple or an EBITDA multiple, if you don't have good insights and support for the revenue that you're presenting to a potential acquirer or investor, it can have significant bad implications on your valuation.
Now you talk about buttoned up. And I know one thing that I was always, I worked for a CFO one time who, they would always throw out this tagline, such as, we need some people in here who knows what good looks like. And I'm like, well, do you know what good looks like? Like, what does good look like? Could you explain what good looks like to me? Because I want to be good and I want to be great. And just like, so you use the term buttoned up, and like, Alex, you're often getting tagged in with some of these early stage businesses. And so if we're talking about buttoned up, like, what does that practically mean? What are you coming in to button up for the businesses?
Yeah, really, I think it's kind of transparency and single sources of truth, right? So what gets confusing and noisy and cause a lot of friction between stakeholders within the team, like say different parts of the internal team, like the CRO and the CFO and the CEO, or maybe with their board or their investors, is when there's a lot of noise around the numbers, right? So what is AR? Like, what is your key metric? How fast are we growing? What was churn? And what is really, I think, important is having a single source of truth of that, and an agreement who's tracking that and how they're tracking that. So there isn't confusion. That the sales doesn't have one AR number and the CEO has another, and then the finance team has a third number. Because then all that kind of friction, all that kind of noise really kind of distracts from strategy and execution.
Well, I mean, we know which person's number is accurate. It's sales number, because theirs is the highest and it's the best and it's the most exciting thing out there.
Right. Yeah. So I'm married to a salesperson, so I have great appreciation for sales. And as Alan knows as well, sales is what makes these businesses. It's not nobody comes into a Series A company and says, "Wow, you got the greatest financial statements. We're going to invest in your business." It's because of that traction. So how I usually explain that to clients is this is an opportunity cost issue. accountants are good at tracking this kind of stuff, setting up rules. Let us do what we do. You go do what you do, and then we're just going to free you from this noise. You go sell. We'll track the numbers.
And if I may add to, sometimes we'll be brought in to help educate the sales team on certain clauses that they may like to include or not include in contracts, and the implications that that might have on revenue recognition, which is ultimately what the company is going to be valued on, whether it's termination for convenience clauses, option renewals, and the like, and just helping educate the sales team so that there's some parameters on what's being agreed to, so that there's a little bit more consistency in the terms and conditions of contracts. Because the more variability you have, the harder it is to have that buttoned up approach to recognizing the revenue.
Yeah, and it just to piggyback on what Alan's saying, then you can craft or adjust your compensation plans, your sales commissions, to sort of a reward or to enforce those kinds of contracts that you want to sign, right? Like if you're trying to sign a 3-year deal, obviously you pay for 3-year deals. You pay your commission for that, right? So sales teams are incented to that. And then I find, Alan, your experience, but once you have these conversations with sales and it becomes transparent, what are the key terms that may cause problems from these kind of metrics, they usually find that sort of very helpful, and then they go off and run off and do what they do and incorporate that. It's that lack of understanding or lack of communication, and usually the lack of understanding is because of a lack of communication with them. But yeah, sales teams are their incentive as well as everybody else in the company to grow, both
All
from
right,
their
I'm
commission
curious.
plus their equity. Yeah.
I'm going to put you both on the spot. You already mentioned one of them. What are the clauses that keep you up at night whenever you're going in to help a customer? And termination for convenience is obviously, the one that everybody thinks of. But if you had to name like your second biggest clause that, within a contract keeps you up at night when you're going through these customers, what would it be? And Alex, will go to you first, and then Alan, coming back to you.
Don't take mine, Alex.
Mine is, oh gosh, what it really is hurtful, especially in moments like this when things get a little slow, is payment terms. People sometimes are overly generous to, especially to large Fortune 500. If you're selling it to Fortune 2000 clients, sometimes they overly give in on payment terms, so you get some ridiculous payment terms like 120 days plus, stuff like that, which really kind of can be very hurtful from a cash flow standpoint.
All right, Alan.
Yeah, that wasn't it. All right.
Oh man.
Things here. One of them is offering quote unquote free additional services or periods within a contract, because that can have impact on when you start recognizing or what the term is, which then also can impact ARR calculations and the like. And a more kind of nefarious one is if you're doing like your standard contract, but maybe entering into a side agreement with a customer with redefined terms and conditions, and maybe that hasn't been properly flown through the entire sales channel so that all the relevant stakeholders are aware of those amended terms and conditions.
These are some nuggets for those of you listening right now. These are some real big nuggets here. It's like if you have termination for convenience, if you're doing free periods, if you have extended payment terms or side terms, these are like we now have the 4 horsemen here in contract management. It's funny on the payment term side, Alex, sometimes, a word comes to mind: leverage. If something goes wrong during that payment term period and I haven't paid you yet, and I find something that's wrong with the software, I have the most leverage I'll ever have, to get my product resolved, because I still have the cash in my bank account. Super, super important for businesses to think about.
Right.
I want to zoom out a little bit here, Alan, because you had mentioned, as we're thinking about the terms of, keeping everything buttoned up and the investor's lens and how that can impact a couple of things. When you get, say a venture firm or an investor, they call you up and they say, hey, we have a new client and we need your team to come in, Alan, and audit the books. What are the 1 or 2 things that are going to be, that you're always like the first place that you're looking, you're like, these are the numbers that have to be accurate. Where does your team get tagged in, and what are the number one kind of the number one, number two things that you've got to make sure that you're validating for the investors?
Revenue. There
you go. Three.
yeah, exactly. It really does boil down to that, because most decisions are made through the lens of revenue and the downstream impacts of revenue, right? Because revenue leads to cash collections, which then ultimately helps you determine what your cash burn is going to be. So everybody is very much focused on revenue, to the point I was in an Uber yesterday to catch a flight up to New York, and I had an hour call with one of my colleagues for us to just strategize on how best to audit the different revenue streams of a particular client. And so we spend an enormous amount of time, not just like looking at contracts and ticking and tying, but making sure we understand the revenue streams and then tailoring our test to those revenue streams so that they're being properly applied within the accounting guidance.
Now, one of the things I always think is really helpful when it comes to, or just call it illuminating, are we could call them war stories. Maybe we call them success stories. But I'm curious, Alan, as you're strategizing and going into one of these clients, do you have any good, call them success stories or horror stories of when it's gone right or gone wrong for a customer when you've been looking at revenue?
I got one of each. I'll start with the bad and then go to the good. I think that's always and on a positive note. In terms of bad, thankfully not so much around fraud or something nefarious, but we've touched a little bit on just contract management and understanding the terms and conditions and the complexities that can be with a SaaS company as you're scaling, especially if you have more complex SaaS solutions that are selling into the enterprise, that just inherently tends to be more complex. And if you don't have the proper systems and tools in place to identify those performance obligations, to then be able to recognize whether it's overtime, point in time, it can take a lot of internal manpower on the client side to actually come up with the correct revenue recognition for each of the key revenue streams, which in our case, what the main issue there is, it delays the audit, which makes the lenders antsy, which makes the shareholders antsy, which makes the board antsy. And it just adds a level of angst across the company until the audit's done and delivered. And so we've come across that multiple times because there are these issues, whether it's competencies, whether it's systems, whether it's processes. And then we just kind of roll up our sleeves and help our clients think through what is the best approach to get to this final answer. But on a more positive note, this was more of an advisory role, but the client was trying to figure out what is the right revenue recognition. They hadn't been audited before, but they were going through a sale process. And so we came in, helped them really think through their revenue streams. And they're pretty well convinced that because we help them consistently, clearly, logically think through the revenue streams and what the revenue recognition should be for them going into this, that they probably were able to net additional 7 figures worth of value out of the deal for them.
I'm curious, how do you net by having buttoned up? Like, how tangibly was it just that the numbers were validated and they were like good, or did you like find revenue that wasn't there at the beginning?
It was more around the clarity of the revenue. Everybody kind of knew the contracts that were there, but what was the true timing of revenue recognition? What was the true kind of like ARR based on those contracts? So a lot of times early on, companies will follow a little bit more of a cash model of recognizing revenue and then use like a side schedule to calculate ARR, but having a more robust defined schedule that was more aligned with GAAP and revenue recognition principles, then they're able to tell a much better forecast for the buyer and more clarity around that.
That's very interesting. So the buttoned up in this case just gave them a more solid foundation to be able to tell the story, since oftentimes in those early businesses, the storytelling is the most important thing. I could imagine how,
yes.
Yeah, if your team, Alan, is the one finding the cracks in the story, we might have a problem or two. And hopefully what you're doing is you're tagging in Alex's team ahead of time, or before the auditors get tagged in to double check everything, you've gotten everything buttoned up. And so, Alex, I want to shift to you a little bit here, because maybe you've seen a couple things in the trenches that have had to get buttoned up before they've slid across the table to Alan. Do you have any horror stories, war stories, or tales from the battlefields that you think might be interesting to tell?
Unfortunately, many scars from many battles. We, a lot of times these things never have a tendency to turn out to be always a correction down. Let's say if things are not tracked carefully, and it rarely works out where things are better than they seemed. So yeah, for example, we were brought in by just recently on an investment bank. They had to pull a process where they were taking this company to like a $10 million plus ARR company, which on the face of it was growing well, and just had all the trappings of a great first round. So they had never taken institutional capital, so everything looked great. But when we got in there, they just had done a really bad job of revenue management. So the books were kind of a mess. And then once we sort of cleaned things up, the trends were a little bit flatter than what people had hoped. So it just caused a lot of angst and a lot of change in expectations. And then so that's just one particular one where, like, if they had done it correct from the day one, they would have made a decision, different decisions about whether they even wanted to go into this process.
Alex, I'm curious, when you first find $10 million business, all of a sudden things, but then you start seeing some of these trends that make them maybe a little bit flatter. Like, what is that? When do you start noticing there's a problem here, and what is kind of the first conversation that you're having? Like, take us into the room with you, and what's going on there?
It's usually in internal accounting, usually should be really transparent and easy, right? It's the one part of life that, like, if there's any accountants on this, everything has to tick and tie, and everything has to balance. So it usually should be pretty easy to step in and see what's going on. And it's usually when you step in and can't figure out what's going on kind of quickly, there's a problem kind of early on. And it starts with, like, hey, can I just see this? You have this revenue on your books, this one particular engagement. Can you give me the contract? And either they can't provide the contract, or when you finally get the contract, it doesn't match what is in the system. And then, that's a great example. It's, you realize there's problems as you just right away.
It's funny how those things can snowball very quickly. If I wind my career a little bit here, as a new hire, eager to do a really good job out of school and direct all of this passion and energy I had to do a really good job. The first place everybody always sent, the first years was the filing cabinet, because inevitably somebody picked a contract and nobody could find it. And so they sent all of us off to, the various filing cabinets or storage boxes that they had, because we had to locate that contract.
You're dating yourself, John, by talking about filing cabinets and storage boxes.
I am. I'm also very mean with a 9 key on one of those fancy the digital 9 keys that you could bring with you to the client sites, and then the others are the 9 keys on the actual scanners themselves. It was always a really good day if the client had paid enough where you could enter your email in the scanner, because then you didn't have to type it in every single time. You had to mail yourself a copy of the contract. But yes, I am dating myself on that. I mean, has it gotten any easier, Alex? Like, we've got all these modern, I think at the time Dropbox had just come out, Box had come out. Like, you don't have to use the filing cabinet anymore. So it should be easy.
Yeah, it's almost like now it's all these virtual filing cabinets are all over the place, and there's not a great. In theory, yes. In theory, this should be really transparent and easy. There should be a single place where those contracts are stored, or a tool where stores those contracts, whether it's your CRM, that's probably the best place, your HubSpot or your Salesforce, whatever, you're storing the contracts there for everybody. That's rarely the case. We find when we start off with clients, usually it's, and sometimes it could be different folders. One for the sales teams keeps their version of stuff, and then finance has their version or doesn't get it from the sales team, and it's going off the invoice. Different things like that. So yeah, no, unfortunately, you would think, but in practice, unless you introduce those processes early on, can quickly kind of very messy very quickly.
I don't know about you two, but when I've used Google Drive pretty extensively the past few years, and my foldering system, I just, I start very methodically, and I'm like, okay, this is folder 1. Here's what's there. Here's folder 2. I think I'm up to like folder 23 with a bunch of documents on the end, and then there are folders within the folders. And now I just live and die by my bookmarks bar, which is growing out of control by the day. Okay. So this is a real clear and present challenge I have today. But, I mean, we're talking about contracts and filing cabinets and Google Drive and some of these things. And we're like trying to tie this into like second time founders care about, like they need to grow their business. But Alan, you mentioned something earlier on about valuation multiples and how those can be tied to, that, you're coming in, they said the revenue was $10 million. If it's solid, great. If it's not, like, why does, that, like, what are some of the implications is where, behind having a buttoned up system here, and how does that kind of impact from the investor's lens, and then also kind of like as a return to some of the early founders? Like, why does some of this stuff matter?
Right. If you're at a 10 million ARR run rate, and let's say it's a 6 to 8x multiple on that, so you're looking at a $60 to $80 million enterprise valuation. But then if it's determined through diligence, determined through Alex's team or others working on just really getting a good handle on the revenue numbers, then you're at 8 million or 9 million. You can see from a multiplier effect how that can potentially really impact and shrink the enterprise value associated with that. Does that mean immediately that's what happens and automatically that's going to be automatic deduction to enterprise value? Not necessarily, but it's a big hurdle then that the management team has to overcome as they're talking with investors and trying to secure that next round of funding.
Yeah. So yeah. I'm, again, mean on the 9 key over here, but I want to do some math for the members of the audience. It's interesting. You were saying $10 million business with an 8x multiple, $80 million business, $8 million business with an 8x multiple, $64 million business. But the other thing, this is something that, we actually talk to a lot, as I've had conversations with customers about this and businesses. Anyway, one of the interesting things is if you go from a $10 million business to an $8 million business, then all of a sudden, like, your year-over-year growth rate from the prior year has also changed. And if your year-over-year growth rate has also changed, that also changes, sometimes you won't get the 8x multiple on an $8 million business because all of a sudden you've dropped to a lower tier. You're not a 40% grower, maybe you're a 20% grower. And if you do that, all of a sudden you take the $8 million business and say you get a 5x multiple. Okay, now we're talking about you don't have an $80 million business, you have a $40 million business. So the value of the total business by just having, say, a slight readjustment to your top line revenue has been cut in half.
Yeah. And, sometimes how we see this play out is when we get involved post investment, and when we start making these adjustments and the deal is already done. But that then is a very difficult first couple board meetings where you're sort of readjusting everybody to that reality that it's actually a smaller business than they thought they were investing in, and there's more to do to get to where they need to get to for the next round or the next exit. And those can be really tense discussions, readjusting to that reality. So even if you end up doing the round, it's like you got to live with these people post round too. Remember, these are long-term relationships that you're getting into, like 3 to 5 years, and it can start things off on a very awkward and difficult.
Now, I mean, Alex, it sounds like you've been through this a couple times, and so we're going from the pre-round bliss to the post-round reality. Like, what does that first or second year look like, the post-round reality? Like, where's the focus all of a sudden shifting in, say, you do have that revision and you're now going from just post-life?
Yeah, in a perfect world, it's okay. We have all this extra capital. We're going to keep doing what we're doing, and now invest in these new things. And that's what you want to be talking to your investors about, right? That's what that investment was all about. Is like, okay, let's do all these new things that we now have capital for. If instead there was, let's say, noise around this, and then somebody like us comes in and says, okay, well, where we need to get to, say we're trying to get to a $10 million, there's these kind of magical numbers, a $10 million value company gets valued at a certain multiple. A $20 million company is going to get valued at a higher multiple, right? So if we want to get to, say, 20 million in ARR for the next round, if you were telling people you're 10, but you're really 8, that's just all the more you need to go to get there. And so that's just a very difficult discussion. Then people start asking, why that was the case, and then it's just kind of not what you want to be talking about. What you want to be talking about is the future, what you're investing in, and all those kinds of things. It's not sort of where you're starting from. And that's, again, it's just part of the noise, reducing the noise and the friction.
Yeah, it is very interesting how, the conversation, yeah, if you have a single source of truth that, ultimately is going to pass Alan and his team, and they're going to say, yep, this is a good single source of truth, or sorry, Alan, I know that you would never say, yes, this is good. You would say, this is a reasonably sure, this is a reasonably accurate source of truth. You can have the conversations that you want to have, versus say, the conversation that you don't want to have, which might be resetting everybody's expectations on what's the value of the business. Obviously people want, that's the conversation that, first time founders want to have, second time founders want to have, all of these growing businesses out there. You want to be focused on, how do we grow this business? How do we, get where we want to go from like our goals and aspirations? One of the key things here is, how do you start from a firm foundation, or when do you need to start thinking about putting in some of the things in place so you don't have a Google Drive that looks like my Google Drive and you're looking at, operating off of bookmarks? Like when's kind of the right time to start thinking about, if you, or maybe another way to phrase the question would be, if you have these symptoms, you should be thinking about calling Alan, calling Alex. And Alan, I'll start with you. Like early on, what are some of the conversations that maybe you or the advisory group at Aprio is having with folks? You're saying, hey, you're having these symptoms. You need to start thinking about getting the foundation secure.
Yeah, I would look at it more through the lens of where they at in their company life cycle. Early on, right? It is all about MVP, product, early customers. Because if you don't get those things, having everything else buttoned up doesn't really matter. You don't want to over-engineer your back office and over-engineer a lot of those things without having a product that people love and are willing to pay for. And so usually I would say, once you get that seed round of a couple $1 million, let's say, and then you're looking towards, in 12 to 18 months, your Series A, that's really a good indicator to start thinking about some of these other kind of internal processes, so that when you go to do your Series A, you do have supportable single source of truth information about your revenue and other things as well that you're reporting on.
Alex, how about you? Are there any so we got seed to Series A. Are there, when any other symptoms that you would say, hey, when you see this? Yeah.
I think there's no reason not to just do it from the get-go, even pre-seed angel. Like at some level, we talk about like just processes. Sometimes you don't want to do the opposite, which is maybe something that Alan's hitting at. You don't want to just throw software at it. Like, that's a classic mistake. If you don't have good processes, no matter what type of tools are not going to help you with that, are not going to help you out of that. So establishing good processes, making sure you have contracts, right? All those, you document your relationships with your customers, and just storing those in one place. Everybody's got the same place, and everybody's using the same numbers from the get-go. I think it's helpful just as early. Now, I agree with Alan. Then maybe systematizing that with different tools may come in later. And then the last thing I will say is, if you have the a contact, a friend like Alan, use it. If we often are talking to our audit partners. If maybe these early companies are not audited, but they'll have a tax firm, and that tax firm will have an audit partner, and we'll talk to that audit partner about these contracts to get their opinions about it. That most people like Alan are very open-minded about that, and very helpful in reviewing contracts to point out these problematic clauses, right? So they try to loop in as many people, free advice as you can early on.
Yeah, the phone a friend is always valuable. And for those of you who are listening in, and we'll also send out some contact information at the end of this webinar. Myself, Alan's, and Alex's LinkedIn profiles are over there on the right. So feel free to connect with us and then shoot us a note. We're happy to give you some phone a friend free advice on this stuff, or dive a little bit deeper with you if any of this stuff is interesting. One thing that I leveraged when I was call it in the weeds myself, not in the weeds as a practitioner, handling some of the books. But one of the things that we've also seen with a lot of people who have, say, come to Maxio over the years is, it can be really expensive to bring in a finance team. I came out of being on finance teams between, call it 8 to 12 folks. And if you're looking at kind of bringing in a seasoned, call it just senior accountant, not even CFO, controller, VP of finance, something like that, you're probably looking at somebody who is going to cost about 75 grand. And that's a lot of money to pay for somebody who can't necessarily even advise you and guide you along the way. And so one of the really cost-effective ways that we've seen some of our customers get this thing right from the very beginning is they'll bring in fractional help. And the fractional firms out there, Alex, I know that you do this, Alan, I know Aprio does this as well. But they all have different flavors of this, from basic bookkeeping all the way up to like strategic CFO advice. And I know both of you all specialize in that. But for anybody who is listening on this, that is a very practical way to get your processes right. Yeah. And then as you're growing as well, to get the right software in place as well, without having to hire, call it a finance team that at scale is probably going to start costing you somewhere between $500K to $1 million annually.
Right. Agreed. Yeah.
I wanted to, I guess one of the ways to end the webinar, so to speak, is, Alan, Alex, are there any, as we think about, learning from second-time founders, and then, learning from experience, the investor lens, anything like that, are there any final words of wisdom that you would leave our attendees with before we wrap up here? Alan, we'll go to you first.
Yeah, don't allow the right focus on contract management, single source of truth, to stymie your ability to sell and grow your business. I would use them as good guardrails to provide some clarity on what maybe your sales team can sell, and that can actually help them in negotiations. They can use the accounting and finance team as the bad guy a little bit and say, hey, we just can't agree to this. And it can help move deals forward, actually, sometimes, if there are these parameters that are clearly defined. So yeah, don't allow all of this to add inertia to be able to get deals done. But it does help provide good clarity.
Yeah. Then I think I would go back to that phone a friend. There's a lot of different resources on, fractional CFOs, or, out on their own out there in the marketplace, or firms like ourselves or Aprio who do out fractional CFO work. So there's a lot of resources out there that are not going to be more expensive than, a traditional bookkeeper at a firm that might not know your industry. So finding people who know your business and can help you at this early stage, I think, is great. And then, there's a bunch of networking events and people like Alan that you can meet at those and will be helpful to you as a future opportunity to hopefully win your business as you grow. I do that all the time. I give free advice, talk to founders all the time about different parts of their business, their financial forecasts, etc. Just in the hope that they'll think about Tarsus when and as if they grow. And there's a lot of people like that out there.
Yeah, I would echo both of your sentiments there. Well, I just want to say thank both of you both Alan and Alex, for your time and for your wisdom and for sharing some of these tangible stories from the field here. Like I was, sharing on the right, if you'd like to get in touch with either Alan, Alex, or myself, feel free to shoot us a note on LinkedIn. Following this webinar, we're also going to send out a copy of the recording. So you'll have, a copy of this. And then we'll also send out, some relevant information, both about, Maxio, but then also about Aprio and Tarsus, in case there are any things like that. And then Dean also just dropped a note in there about, if you have any questions about, Maxio or anything that we can do to support anybody on the webinar, we're all here for you. But thank you again, everybody, for the time. Alan, Alex, thank you again. And we'll hopefully do this again in the near future.
That's good.
Thank you, John.
Thanks.